Hey everybody, welcome to another episode of Foreclosure Help 777, where we talk about everything foreclosure related. I hope everyone's doing okay out there. I know the flu has been going around, and I had it for a few days, and it was really bad, and I'm just getting back on my feet. So, if I'm a little sluggish today, that's the reason why. But I don't want to let y'all down. I know a lot of y'all tune in every week to watch my videos, so I don't want to let anyone down. Today we're going to talk about loan modifications and why those are important and some things you might want to know. Understanding loan modifications, how they work, and hidden traps to watch for. A loan modification is a permanent change to the terms of your mortgage loan to make payments more affordable. Possible changes would be interest rate, loan term, payment amount, arrears treatment. An important point is it's not refinancing. So why lenders offer modifications? Servicers prefer modification instead of foreclosure because foreclosure is expensive, property values may drop, investors may require loss mitigation review. Borrowers usually must show a financial hardship, stable income, ability to make modified payment. Interest rate reduction modification. These are common modifications. The lender reduces the interest rate and therefore the monthly payment decreases. Here's an example. An original loan has a 7.25 interest rate. A modified loan has a 4.5 interest rate. Lower the rate, lower the payment. Another way they modify loans is like an ARM loan or an adjustable rate mortgage to a fixed rate conversion. Some modifications convert an adjustable rate to a fixed rate loan to make the payment stable, protection from future rate increases. Important question borrowers should ask: what is the new fixed rate and how long does it last? Another thing is capitalization of arrears. This is one of the most common modifications. If you couldn't pay your mortgage and it's in arrears, what happens? The missed payments and the late fees and the escrow advances are added to the loan balance. Example, let's say your original balance is $200,000 and you're in arrears for $25,000. Now your new loan balance is $225,000. A term extension modification. Here's another common structure. Loan term may be extended to 30 years, 40 years, sometimes longer. The benefit is of course that lower monthly payment amount, and the risk is the borrower pays much more interest over time. Then there are these partial claim deferred balances. Some programs move part of the debt to the end of the loan. Here's an example. The loan balance is $250,000 and $40,000 of that is deferred. The borrower pays on $210,000 and that $40,000 becomes due later, often when the home is sold or the loan is refinanced or the mortgage matures. Now, some hidden traps borrowers must watch for. Important warnings: potential traps, balloon payments, hidden deferred balances, trial payments that never become permanent, increased loan balance after modification, modification that resets the loan term. Always review the final modification agreement carefully. Key questions that borrowers should ask before signing a loan modification. What is the new loan balance? Is any portion deferred or ballooned? What is the new interest rate? Is the rate fixed or adjustable? What is the new loan term? And then let's talk about the trial payment plans, or they call them TPPs. The trial modification trap. What is a trial modification? It requires borrowers to make 3 or 4 reduced payments while the servicer reviews the loan for a permanent modification. Borrowers often believe, if I make trial payments, my modification is approved. That's not always correct. What borrowers must understand is making trial payments does not guarantee a permanent modification. Servicers may still request additional documents, deny the modification after trial payments, claim documents were incomplete, continue foreclosure activity. And we know what that's called, dual tracking. Common problems with trial plans. Homeowners report problems such as documents repeatedly lost, servicers asking for the same paperwork multiple times, foreclosure continuing during review, trial payments accepted but no permanent modification offered. The risk. Borrowers may make several trial payments believing that they are saving their home, only to learn later that the modification was denied, foreclosure proceeds, arrears have increased. Important advice for borrowers. Always ask the servicer, what are the conditions for a permanent approval? What documents are still needed? Will foreclosure be paused during the review? Always keep copies of everything, guys. Your payment confirmations, submitted documents, correspondence with the servicer. A trial modification is like being in an interview stage for a job. You're not hired yet. That analogy helps people immediately understand the risk, right? So who actually owns your loan? Many mortgages are sold after origination. The common structure: borrower, servicer, trust, investor. The company collecting payments may not be the owner of the loan. Example, servicer is Nation Star, or Select Portfolio Servicing, or PHH Mortgage. The owner, on the other hand, might be U.S. Bank for a mortgage-backed securities trust. Endorsement in blank. Let's talk about that. If your promissory note is endorsed in blank, this means that the note becomes bearer paper. Whoever possesses it may enforce it. But the problem is borrowers may not know who actually owns the loan. And why this matters before accepting a loan modification? A loan modification is a new binding contract. When borrowers sign a modification, they may reaffirm the debt, waive defenses, or acknowledge the lender's authority. So borrowers should know who they are contracting with. And if there's any doubt, you need to get to the bottom of who actually owns your loan. How borrowers can request proof. Before agreeing to a modification, borrowers should request copy of the promissory note, how it looks today, all endorsements or allonges, assignment history, identification of the loan owner or investor. Requests can be made through RESPA, request for information, or a QWR. That's a qualified written request. Services are required to respond to these. And key questions borrowers should ask: who is the owner or investor of my loan? Services are required under federal servicing rules to provide this information if requested. Practical advice for homeowners: before signing a modification agreement, review the modification terms carefully. Confirm the servicer has authority to offer the modification. Request documentation if ownership is unclear. Once a modification is signed, it may limit certain defenses in future disputes. Why servicers sometimes prefer loan modifications. Foreclosure is not always the best financial option for lenders or investors. In many cases, loan modification is less costly and less risky. Little or no equity in the property. If the loan balance is close to the property value, for instance, example, if the home value is, say, $300,000 and your loan balance is $290,000, after foreclosure costs, the investor may lose money. Typical foreclosure costs: you have your legal fees, trustees' fees, property maintenance, resale costs. A modification may allow the investor to recover more over time. Foreclosure is expensive. Foreclosures can cost lenders attorney's fees, court costs, property taxes, insurance, maintenance of vacant property, and these costs reduce what the investor recovers. Investors often require loss mitigation review. So mortgage-backed securities trusts often require services to attempt loan modification, repayment plans, forbearance before foreclosing. This is part of the servicer's contractual obligations to the investors. Servicers earn fees from performing loans. Services are paid to service loans that are performing. If a borrower resumes payments through a modification, the loan becomes performing again and servicing fees continue, and this gives servicers an incentive to modify loans when possible. Avoiding vacant property risk. Vacant homes can create problems. Property damage, vandalism, declining property value. Keeping a borrower in the home protects the value of the collateral. Key takeaway. Loan modifications are sometimes offered because they benefit both the borrower and the investor by avoiding the cost and risk of foreclosure. But I should also let y'all know something else. When I was fighting my own foreclosure with Bank of America, the servicer pushed me into foreclosure and played all kinds of games with my loan modification paperwork. And I found out later when I was in litigation that servicers only really make money when they foreclose on property. Those fees that they get when they service a loan are nothing compared to the money that they get when they foreclose. So there's always that as well. Anyway, guys, I hope this information has been helpful. If you're thinking about getting a loan modification, be very, very careful. Get copies of everything and stay in communication with them, and you should be okay. But there are some really nasty servicers out there that will still play games no matter what you do. And if you have to sue them, you have all the paperwork that will support your lawsuit when you have to sue them. So keep copies of everything, especially loan modification paperwork, in case you have to sue them later. Okay, if you have any questions, you can leave them in the comment section below. And as always, I hope everyone has a blessed day.